Hello and welcome to LBMA webinars. I hope you've all had a lovely week and that you're ready for today's webinar, which is the second release from our recent virtual Precious Metals Conference and is the opening session. The Global Macroeconomic Outlook was led by Richard Quest. Richard is the business consultant for CNN. And he hosted a panel including Philipp Hildebrand, who is the vice chairman of Blackrock, Joachim Nagel, who is the deputy head of the banking department at BIS, and Avinash Persaud, who is emeritus professor at Gresham College. The panel talked about various topics, including inflation, tapering, the effects and impact of net zero, and they also talked about gold and cryptocurrencies. So let's take a look at the recording.
Wherever you are, be it a good morning, good afternoon, or a good evening, I'm Richard Quest from CNN and delighted to be asked and honoured, and thank you for asking. I'm going to ask our panel in sort of true come on down style to unmute themselves. There you go. Philipp Hildebrand, who is the vice chair of Blackrock, former central banker of Switzerland. Good morning to you, Philipp. Nice to have you with us. There's Joachim Nagel, who is the deputy head of banking department at the BIS, who tells me he is at the BIS. And no, I can't have that magnificent painting behind him, but it will give us smooth sailings ahead. Avinash Persaud, of course, is the emeritus professor at Gresham College, joins us. Good morning, Professor. Beautifully. Morning. First of all, let's establish where you all are. Philipp, where are you this morning?
I'm in Zurich this morning in the office, Richard, so that feels good.
In Zurich, you're not WFHing. Joachim, where are you?
I'm in Basel, Richard.
Avinash?
I'm in London.
And I'm in New York, which just goes to show the global nature of LBMA and indeed of our discussion this morning. You heard Ruth say, where's the price going? I guess I could ask each of you that question, and with years of tact and diplomacy, you would tell me you've really not, that's not the sort of thing you talk about, and in a very polite way, tell me to go and stuff myself. However, we are going to look at the drivers behind it. And I think we have to start there with I can't decide between general border, big picture economics or really inflation. Let us start with economic growth, I think, and start with you, Avinash. Where do you see, I know it's going to be differentiated between Europe, developed, non-developed, emerging, Asia, ex-China, China, but where do you see economic growth globally?
Well, Richard, I think that what one is always thinking when you're looking at a market price is, where is the market likely to get it wrong? Where is the consensus likely to get it wrong? And we tend to be familiar with demand side shocks to the economy, like a big recession, the global financial crisis. This has been unusual. This is a supply side shock. People aren't doing things not because they don't want to do it or they don't have the cash to do it, but because we don't let them do it. We don't allow them to do it. And supply side recessions tend to be sharp, abrupt, but they're more short-lived than the demand side stuff. So I think the recovery will be stronger and quicker than most people will expect, even though there's a lot of uncertainty because of the medical issues.
But Philipp, you'd agree that that recovery, what one might describe as the bounce back, will be pronounced, and we saw that in Q3, Q4, Q1, very strong rebounds. But is it sustainable going into the rest of this year and into 22, do you think, Philipp?
I think it's, I would very much echo what's been said. I don't think we should use the word recovery. It's really a restart for precisely the reasons that Avinash mentioned. So you're going to have very different dynamics. We've seen, because you sort of turn it on, all of a sudden you see supply chain problems, you see wild price movements, frankly, quite, wild activity movements as well. And you have the uncertainty that you could have a renewed sort of punctual lockdown interfering with it. So I think we're still in a phase where we're going to see a lot of volatility in the data and probably shouldn't pay too much attention to it in the very short term. The question is, where does it settle, right? At some point, this is going to settle back as the supply chains normalize, as we have more visibility on COVID. My guess is it settles not too far from the potential growth rates, 6 to 8 months from now. So we will have had this kind of extraordinary initial restart with very high GDP numbers, but also lots of volatility. And then that settles into something that will look more normal as we head into 2022. The big question will be where inflation settles. That's a whole different topic. That's probably the most important theme in a sense if you think long term.
Right, and I left that to sort of follow on from growth, because inflation, as would normally, 1 + 1 = 2, growth plus inflation, etc. However, Joachim, we have this unusual circumstance of stimulus, both monetary and fiscal, which, Joachim, has forced inflation back into the system.
This is right, Richard. I think definitely this is right. I think nobody would disagree. But I guess we shouldn't forget that we went to a really exceptional phase. This was something, I think, from a financial market perspective, in my understanding, it was the most challenging thing we went through in this century. So we shouldn't forget this. And what monetary policy and fiscal policy did, I think they stabilized the market. So I think one of the side effects is maybe the inflation question. But nevertheless, we shouldn't forget that all what monetary policy and fiscal policy did was, from the BIS perspective, really a very helpful tool to really give us a lot of cushion to really deal with this situation. Yeah.
So, Joachim, in a sentence, is the inflation we are seeing transitory, or is it starting to get sticky?
Well, I think this is a 1 billion question, but it looks like if we really take the financial data, it looks like that it is transitory.
Let me disagree. Because I think the first thing to say is we've had this most amazing, as Joachim rightly said, response. The IMF said it's a $20 trillion response, both in monetary and fiscal expansion, 19 of that in the developed countries. So as you said earlier, Richard, there's going to be a split between the developed and developing. $19 trillion of stimulus. And what have we learned? I think most of us are Keynesians these days, but the challenge with Keynesian economics is how do you withdraw that kind of stimulus? If we're saying that it's a temporary problem on the economy side because it was supply side led, you've got a permanent kind of stimulus. How do you withdraw that? Not easy at all. And there are two other reasons I would say that the market risks underestimating the persistence of inflation. One is debt. Inflation is two fundamental things. It's debt and it's politics. Inflation is a political inability to get a consensus between debtors and creditors. Politics is not looking good and debt's very high.
All right, but Philip, let's put politics to one side, because heaven forbid central bankers have to take into account political aspects in their decision making. On the raw inflation, where do you stand? Transitory or starting to get sticky?
I think it's again, if we think in a restart framework and not a recovery, where I would end up is, in a sense, it's a bit the wrong question, or you could answer it in a way by saying both, right? It'll be transitory in the sense that we're not going to have, hopefully, 5, 6, 7% of inflation, as we've seen in some cases. But I'm convinced, frankly, that inflation will trend higher, that we're ending in a higher inflation regime than we've been in the last couple of decades, depending on where you're looking at it. And for several reasons, right? We've talked about some of the reordering of global supply chains. This leads to higher production costs. I think the trend towards net zero, frankly, will also at the margin lead to higher production costs. And then, very importantly, you have a new monetary policy framework, which consists essentially of making up for past undershooting by not only accepting but aiming for future overshooting for some time. And I think that has moved expectations, or will move expectations. So all in all, I would expect a higher point of settlement, in a sense, in terms of inflation.
That's valid. And if 2% was the previous pretty much accepted number, in the new asymmetric environment, tell our guests here today, what numbers, if they see, should they not be afraid of?
What I have in mind is a kind of a regime that settles around 3%, maybe a little higher for some time. And again, the key, and this will be in a sense, the trick of this generation and the next generation of central bankers, to ensure that as you settle into this new regime, you keep inflation expectations anchored. The largest shock that could occur to the system today, given the debt levels that Avinash mentioned, would be if we cannot contain interest rates, right? If you suddenly had to have much higher interest rates, that would create terrible debt problems. So the very delicate kind of narrow path here is to aim for this higher inflation regime, different from the past, but to keep interest rates in what we have referred to as the new nominal, where interest rates remain low, relatively low. Central banks will not respond quite the same way they would have in the past, and therefore real rates probably stay negative for quite some time.
Maybe Richard, if you allow, I would like to come back to the word transitory. In my understanding, this is the word of the year in financial markets, transitory. In my understanding, isn't that a nice tool, a nice semantic tool for central bankers to create constructive ambiguity? I think this gives you all the room to do the right thing. So it's a little bit, what I would like to say with this, it's a little too much emphasis on that word transitory.
So if there's too much, in your view, emphasis on that, in a practical world, the lady is not for tapering in Europe, says Madame Lagarde. Jay Powell is going to start tapering later this year, probably, or early next year. The market has seen tapering before after 08, 09 crisis. So, Avinash, should we be aware? Well, we're aware. Should we be alarmed as tapering begins?
I think in the beginning, no, because inflation still is only slowly emerging. But I think the question is, as interest rates start to rise with a greater momentum, risk appetite is something I know Philip wants to talk about, and risk appetite is hard to get risk appetite very low when interest rates are very low. When they start rising to a different level, then I think we're entering a different phase. But I want to pick up something, Richard, that Philip mentioned, which I haven't heard being said enough. And we've talked to, and Joachim made this nice distinction about transitory permanent. There's one permanent thing here that Philip mentioned, which is net zero. Inflation started in the 70s because of cost push inflation, not demand. It was the oil price shocks. We're going to have a carbon shock if we really do make the effort to go to net zero. As many countries are now declaring up in Glasgow in a month's time, they're saying they will. If they do, it's higher cost of production, higher cost for consumers, and that gets embedded into inflation, and that's long-term, not transitory.
Right, but if that happens, we sort of know where that's coming from. That's the inflation that you can handle, you can forecast, and you can price in.
So the other point you mentioned is when you're dealing with financial markets, it's not about point forecasting. It's about where is the consensus likely to get it wrong. And what we've learned is that policymakers find it much easier to put on stimulus than to withdraw it. And for the points you made earlier, it's going to be tough to taper at the right pace. It's going to be hard for us to know what the right pace is. So the bias will be to be too slow.
Okay, Philip, if they taper, and I mean, tapering is merely a precursor to rate rises. We saw with the Fed the last time round, the speed with which they moved from taper to rise. Would you expect it to be longer or shorter this time? Bearing in mind the nature of the inflation, as you say, is supply-led.
I think they will make it very clear that it's not a precursor. In fact, the Federal Reserve has already done that effectively in Chairman Powell's speech, that it's kind of one is a technical adjustment on the liquidity side, which makes sense given where we are. And my guess is the market will take that reasonably calmly, particularly if the central banks make it clear that it's precisely not a precursor to rates. The rates, given the new framework, given the deliberate attempt to overshoot for some time and to tolerate inflation, not just to tolerate, but to actually aim for inflation to be above 2%, does not lead you to expect anytime soon to see an actual liftoff. The real kind of interesting moment in markets, I think, will come when we approach that liftoff date, which at this stage I would say is the earliest in 2023, and maybe later in the case of the European Central Bank. So I think we're quite a ways away from it, and all of it will depend, I think, on this critical point. On can you? This is a sort of narrow path into paradise. Can you adjust inflation to be at a higher level than we've seen it in the last couple of decades, so above the 2%, and yet maintain the anchor so that it doesn't start to drift away from there and start to kind of recreate a period like the 70s. There's lots of scope for policy mistakes here, misunderstanding in the marketplace. You can see this around the kind of proper understanding of the new framework at the Fed.
So, and aren't you overturning 50 years of economic theory, which basically said the reason why we got inflation in the 70s is that we were trying to fiddle around with moving the average inflation rate up from 2 to say 3, and the problem is inflation is accelerating or decelerating. It's never stable. So and that's why they wanted to get it down to near zero.
So answer this question from Isabel Strauss-Kahn, who's just taken Philip, this question came in. We'll start with Joachim on it though. So do you think, bearing in mind what the three of you have just said, time to come off the fence, do you think that the new monetary frameworks of the Fed and the ECB will work to contain inflationary pressures? Joachim, you first.
I think if I take the, let me say, maybe the reaction function of the financial markets, before I come back to Isabel's question, I think important to me is, despite the fact what we just discussed, if the rate hikes are coming in the future and inflation is maybe picking up and things like this, I think the financial markets are pretty much prepared for a situation like this. And this is an important point here, Richard, to answer this question. I think we are in a much better off situation compared to the last financial crisis. So the banks are in a better situation, the capital buffers are higher. And now coming to Isabel's question, yes, I believe that the instrument, the monetary policy framework that is being provided by the Fed and by the ECB could deal with this situation.
Philip?
Well, I have great faith in my successors, so I would say there's a good chance they can pull this off. I would like to see a bit more in terms of guardrails, particularly in the case of the Federal Reserve. I think the new framework really makes it very difficult to anticipate, how far this overshooting will go, and probably could benefit from some specification down the road. Now, the tricky part will be to do that without somehow triggering anticipations of an early rate rise. So I understand the reluctance to specify, but I do think some specificity around guardrails of how long are you going to let this inflation overrun or compensate or this makeup strategy will be key in ensuring that these frameworks can pull this off by having inflation settle higher, but without triggering a change in inflation expectations.
Avinash, give a quick one on this, on whether you have confidence in it, and then I want to move on to net zero and other precious metals. So, do you think, on Isabel's question, that they'll be able to do the 3-card trick?
Well, look, we've got a great set of central bankers at the moment across the Atlantic and elsewhere, but I think it's unlikely so for 2 reasons. Firstly, we tend to fight the last fight. I mean, fiddling around with making inflation more symmetrical, as Philip said, and that was partly because the last fight was deflation. Now we're in a different environment. Will they be able to move quickly enough? And the second thing is, inflation is not technical. It's not about the technical ability of central bankers, bless them. Inflation is political. Do you have a political consensus in the world today to keep a lid that is strong enough to keep a lid on inflation? It may not be the right thing to do, let me say that, but I don't think that political consensus is there.
So if we turn to this idea of net zero, Paul Fisher, by the way, says he doesn't agree that net zero will deliver an upward inflation shock. Renewable energies will be cheaper than fossil fuels. But if we take, I see you disagreeing there, you can disagree with Paul in a second there, Avinash. Hold the thought. If we look at ESGs and we look at the growth of electric vehicles and we start to consider the other non-gold precious metals, Philip, we are seeing an environment where this particular market, I mean, the increase in demand for palladium, for platinum, for other metals and commodities related to EV ESG issues could be huge.
Well, yes, look, I think the way we should think about the journey to net zero is this will be the greatest transformation of the global economy certainly any of us have ever experienced, and arguably perhaps the greatest transformation in the history of the world. The only thing that comes close to it in a sense is the introduction of fossil fuels starting in the 19th century that created the economy that we have today. So every region, every sector, every company will be impacted, and in a sense, you know, let's hope it can be orderly, right? The longer we postpone action, the more dramatic it will ultimately come. This is a trade-off in a sense between transition risk, having to change your business model, or if we don't, then get the physical risk of the physical effects of climate change and global warming. So I think what's ahead of us here is a profound transformation of the global economy, and that will entail, and this is kind of our thesis, a tectonic shift, a reallocation of capital that will affect, you know, it's hard for me to think of a sector or a company that will not be affected by this over the next couple of decades.
And to the extent that we seeing, Philip, are we seeing that reallocation of capital? We know it's beginning, but is it, do you feel it is picking up steam? Is it dawning on the investor community, thereby creating, pardon the pun, what could be the next gold rush?
Very much so. I think we are convinced that we're seeing it. We're seeing it in our own platform. In a sense, you know, we're lucky we have a bit of an ecosystem, a mini ecosystem of the global economy, so we can observe these trends. And there's no question in my mind that shift has begun. You know, the big issue will be how long can it run before you meet some new equilibrium. But I'm convinced that we're only at the very beginning. Now, you know, the key here to emphasize over and over again, Glasgow is therefore very important. For this to work in an orderly way, we need clarity and we need leadership by the governments. The governments cannot step away from this and kind of hope or expect financial markets to do the work for them. Markets need to be guided. The commitments have to be clear. The governments have to lay out a path to net zero in terms of either regulation, taxation, standards. Otherwise, this is going to get very, very messy. But I think there's no question that we're going to see persistent reallocation of capital as we get on this journey and as the journey accelerates.
Maybe Philip, if you allow, can I make one point here? You just raised the point, and I 100% agree that it needs leadership. But doesn't this leadership come, and this is going back to the question of Paul Fisher, if net zero is really coming with no inflation pressure? I think if you want to take this role, being a leader, want to transform your economy into a new type of economy, then I guess it goes via the price mechanism. This is my point here. So we need higher carbon pricing for going to this new equilibrium. So I believe, and this is the long answer for Paul's question, I disagree. I believe that net zero is coming with inflation pressure.
Right.
I think there are two things to say. I mean, firstly, let's be real and not get too carried away. We've made very little effort so far in dealing with global warming. I was born in Barbados in the Caribbean. The Caribbean's on the front line on climate change. Us here living in the northern climates, climate change is not really impacted. I was in Dominica trying to rescue them after Maria. They lost 226% of GDP in 4 hours. Those countries on the front line are trying to do their best to changing their whole energy spectrum. And when we've been doing that, so I've been heavily involved in that, it has cost more money. To Joachim's point, to get the investors...
Does it matter though, Avinash? Does it matter that it costs more, that there is a net zero inflationary premium? Does it matter, bearing in mind the bigger picture?
Matter for what? Better for the world, but not better for inflation.
Which thereby, for the people watching today, would say, in terms of the precious metals commodity.
Yeah. I mean, certainly, what we're having to see is a social benefit turn into private price signals, to Joachim's point, and that initially, at least, is going to require cost. So far, the most successful countries at changing the energy spectrum have been those that have shifted prices to consumers with much higher feed-in tariffs.
Related to this, though, if we are looking at a precious, Joachim, if we are looking at a precious metals industry that stands to benefit, I would suggest twofold here, Joachim, and this is without giving a price forecast. Firstly, by demand for the product that's going to go into all these new electrical vehicles, etc., etc. And secondly, because of an inflationary outlook that increases, as the three of you all seem to agree. Joachim.
I think, Richard, this is definitely a question for the other two colleagues, because the BIS, I will not give you any market forecast. So, but the point I can make here, I think gold, maybe concentrate my answer on gold. Gold was, in any decade, in any century, a good yardstick for macroeconomic shifts. And so I guess it will be again this time. This is my very diplomatic answer for your question.
Avinash, you're less diplomatic.
I mean, I think that based on my time in financial markets, I try to look to see where consensus is. Despite the best efforts of the rational expectations of theorists in economics, that's not the way market expectations go. They tend to be more adaptive based on the past, rooted, anchored in the past. I think we're going to find it that this recovery will be stronger and inflation will be higher than expected. And that's clearly a positive thing for gold. And moving to net zero, as you said, has an actual demand for gold and precious metals, as well as adding to that cost structure.
Philip.
I think that's right. I mean, the one thing that comes into this, of course, will be innovation, right? We don't know yet exactly how this transition is going to work. We're going to need a lot of new technology. That's pretty clear. Just to give you one data point, the reduction in CO2 emissions during COVID as a result of COVID is essentially what we would need over the next 10 years every year if we wanted to stay on the direct track to net zero in 2050, i.e. halving emissions by 2030. And you can see that, already this year, we're going to be way off another -6 or 7% of CO2 emissions given the reopenings. So it's pretty clear that part of this has to be new technology. This is Bill Gates' argument. And of course, at this stage, we don't know yet what kind of resources will be required or will be in great demand as part of these new technologies. We can have a sense, and many of the precious metals that you mentioned are probably part of the story, but it's hard to make a firm prediction of who is going to be the actual specific beneficiary. What I will tell you with great conviction is we're going to see big changes of relative prices going forward as this transition takes hold. That seems clear to me.
And just to clarify, on that point of it, Marcus Garvey's just contributed. Richard, palladium is arguably the biggest structural loser for the arrival of EVs. They don't have catalytic converters. This really benefits copper, nickel, etc. Staying with this idea of debt and the amount of debt that central banks have taken on, well, governments first of all have taken on through their various fiscal policies. We now have major G7s with, well, they're all major, but with debt GDPs over 100%, and we have central banks stuffed to the gills with bonds. Philipp Hildebrand, is this a worry for the future? If so, what?
Absolutely. I think it's perhaps the kind of existential worry going forward. I remember a session a bit before Mario Draghi became the leader of Italy, where he said, and I still recall this, those countries that will fail in elevating growth as a result of all this spending, potential growth, will ultimately face debt sustainability challenges. And I think that's exactly right. So we have, in a sense, from a macro perspective, we have two great challenges, right? We need to elevate potential growth, at least somewhat, in order to have a better ability to deal with these debt levels. And number two, we really can't afford for interest rates to go up too much. This is what we refer to as the kind of new nominal environment, where even though you have inflation moving higher, you have to ensure that things stay well anchored so you don't have to adjust interest rates too much. And that's the narrow path to paradise. If you had suddenly rates going up very significantly, the debt burdens become very, very difficult, right? So, that's clear.
So just on that, I always think that one's real life is a good barometer for how messy things can get. For 1,001 reasons, I had to look back at some previous mortgage transactions. In 1991, I took a mortgage out here in the US where the rate was 9%. I saw another one where I took out in the UK where when I took the mortgage out at the beginning of the 2000s, the rate was 6.5%. These, Avinash, these are fanciful numbers, horrific numbers at a time when people are paying 1% or 2% over base.
That's right, and so Richard, you and I are perhaps older than many of the people watching, because they don't remember that. They don't remember that the average interest rate, when I started in the City of London in 1988, the average previous interest rate was around almost double digits, and people don't have that expectation for them. But I think you called it the three-card trick earlier. It's as Philipp and Joachim have described it, this narrow path. So they need to get growth. If you look at countries that have been successful at getting their debts down, it's partly because of the contribution to growth. So you need to get growth, but you also need to pull back stimulus, a very tough environment. And that's partly going to lead, I think, to some inability to be tough enough on the inflation front.
So you said,
but maybe, Richard, taking your anecdotal evidence, I think this was the nominal rate and it was not the real rate. So during your time when you took your first mortgage in 1991, I think the inflation rate was, I'm not sure about the real number, but I guess it was close to 7-8% during that time. So your real rate was much lower than the nominal rate you had to pay in 1991. And this is the important point here. And coming back to what Philipp said, I think this is the major concern we should have when we're talking about government debt. I think if there would be a kind of a jump in interest rates, that would be a catastrophe for financial markets, not only for the governments, I think for all of us. So I think the challenge will be to have a gradual, let me say, path where you might increase, taking the first steps, doing tapering, and then maybe later on in a later stage, you start to increase interest rates. But all the other things that are being discussed around would really end up into a mess.
Okay.
And real rates today are negative. So we're going to go from significantly negative real interest rates to modestly positive real interest rates. And that transition is not going to be easy.
Do you see, Philipp, do you see this transition, which is happening now to an extent, over the next 12 months? I guess there's a huge gap between totally disruptive and smooth sailing. Where do you see that transition going? Where would you put it on the arc of probability?
Well, on the inflation front, I would hope that by 12 to 18 months from now, we would see that inflation will have moved, will be in a new environment, but will kind of continue to be, inflation expectations will continue to be well anchored. So I watch expectations very, very closely, almost not on a daily basis. That's pointless, but I think as we think over the next kind of 12 to 18 months, that's the critical question. In other words, can this trick, in a sense, be pulled off, right? After all, let's not forget the only reason we were able to generate so much debt to get us through this COVID period, as Joachim said in the very beginning, was because rates were so low and because to some extent we eliminated or at least softened the boundaries between central banking and fiscal policy. And over time, we'll have to reestablish that, which will be very, very delicate. And I think the key is to do it in a way which doesn't undermine long-term inflation expectations.
I want to finish talking about the crypto and excuse me, the role that the proper role, if any such be, that you see in crypto. And here, Joachim, I'm going to start with the BIS because it seems a suitable place to begin. Firstly, as a store, I mean, I guess we've got three things here for crypto, haven't we? We've got it as a speculative investment, where nobody would disagree that it is that. We have it as a potential store of value. Well, if you're in El Salvador, you might be questioning that. And thirdly, you have it as a currency. And central bankers seem to be heavily against the idea of it being that. Where do you see the proper role for crypto?
Richard, as long as there are no CBDCs, cryptos are for me an asset class, not a currency at all. Because I believe, and we shouldn't forget this, I think a currency needs the trust of the institution that is behind this currency. So my short answer is, at the moment, I don't see this as a currency, I see it as an asset class. But as I said, I also believe that it's the right point in time that central banks, and this is what happened, are dealing with that issue of issuing CBDCs in the future. And I think this is an important step forward. And I guess you heard it, that the BIS is very much in favor of partnering the central banks for this endeavor.
Right, but the central bank governor of Denmark, who I interviewed recently in Copenhagen, he basically said, look, we did a 5-year study of this. We looked at this. We realized there is no purpose to CBDC. It does not add anything that, if you're talking about digitally being able to transfer money, we do it anyway. So tell me.
Yeah, Richard, I disagree here. If you look, for example, for cross-border payments and for limits to limit the risk of currency substitution, I think there are some, let me say, really advantages that could come from such a development, that central banks are getting more into this. So I'm not so skeptical like the Danish central bank governor.
Philipp,
well, yeah, I guess, Mike, not surprisingly, my answer lies very closely to what Joachim said. I think as long as we continue to live in a world where governments, the system is made up of states, headed by governments, money will become digital. I have no doubt about that over time. Even if we see limited advantages at the moment, I think there are some, but money will remain sovereign. And that gets me back to essentially the same place where Joachim is. Again, the one thing that could derail that, if the system of fiat money completely loses credibility. In other words, if, again, it comes back to this core question of inflation expectations. Because after all, the way we've built fiat money, which is sovereign money, whether it's physical money or ultimately digital money, is of course based on the notion that governments and their central banks can preserve an environment of price stability.
In the event that sovereign or fiat money became disreputable, for my words, not yours, but you know what I mean. But in the event that happened, then the digital currencies created by those CBDCs would also surely attract the same opprobrium to it or disapproval, because it's backed by the same institution and the same economies, and therefore arguably it would only be the bitcoins that could continue a store of value because of the way they've been constructed.
Yeah, which is why I think the way we should think about this is not so much digital money or physical money, but rather, do we have a private money or public money? And as long as states remain the building blocks of our system, as long as we can live in a world where price stability is anchored, I see no reason why private money should become of dominant use. Public money, whether it's digital in the future or physical today, and as you said, much of it is already digital in reality, will remain the core piece of the system. And again, that just shows you how much is at stake in this inflation adjustment exercise, how important it is to preserve the anchor of price stability as we go through this period of trying to elevate inflation without losing control.
Yeah, what's interesting, Avinash, as we come to the last 2 minutes, is I just want to draw a strand together here, because I can hear some of the people saying, yeah, but there's Dogecoin, there's Bitcoin, there's Ethereum, or whatever. But they're looking at it arguably as a speculative investment, as an asset class. If I understand what the three of you are saying correctly, is for this industry, the precious metals industry, the focus needs to be and must remain on economic fundamentals in the various economic producing countries. Is that what you're saying?
Let me add a related dimension. And I learned this lesson, in fact, perhaps when we first started talking to each other, Richard, I was a bit of a lone voice in the UK saying that the euro was going to arrive, and it could be a strong currency, and it could be a reserve currency. And I was corrected by my friend at the BIS at the time, Bob Macaulay, who said, well, for a currency to succeed, people have to issue it. And it can't be too strong, because no one wants to borrow in a strong currency, a currency that keeps on going up. And you're seeing that with Bitcoin and other things. If you are structurally having a strong asset class or strong price, it won't catch on, because money is actually about debt instruments that are easily traded, and no one would really want to have a debt in this currency. I do think also people forget that we've had private money before, and it didn't work out very well. In the 19th century, the world was awash with private money. And that's why we got to central banks and others, because it doesn't succeed. Money is a social construct.
And on top, maybe Richard, I think we are all suffering, I believe, from time to time from cognitive dissonance. That we forgot that in the past it was often the case that central banks had to intervene into all the asset classes we are talking about here. And I promise you, Richard, it will come in the future that central banks has to take also this role here when we're talking about cryptocurrencies. So I believe this is the reason why I said this is an asset class. It couldn't be something as being a kind of a new currency or something like that.
All right, so if it's an asset class, and this is where you're all going to feel the heat come up underneath you to some extent. If it is an asset class, is it an asset class that rivals gold as a store of value? Avinash?
I don't feel so, because I think that ultimately it is a constructed asset class. It doesn't have an underlying use. As we know, gold has underlying industrial and jewelry uses, as well as a universal preference for the metal. So I think that it is constructed and will only gain value if people want to use it. And when people start to realize it can't be a currency and it won't succeed as a currency, I think its use will fill. But that doesn't mean to say it can't go up a little bit more. And as Joachim described it, a speculative asset class. People have bought all kinds of weird things before and made lots of money and ultimately lost lots of money.
Joachim?
I believe that gold has a totally different mystic compared to cryptocurrencies. And so I believe that cryptocurrency has now, let me say, a history of a little bit more than 1 decade. Gold has a history of thousands of years. So I'm still a great believer into the asset class of gold.
Philip?
Look, when pushed, I've also referred to gold as something that might be an interesting comparison to this asset class. There is one huge difference, and I think it's very, very important, and I join my colleagues in that. Gold has been used by governments extensively including in recent times. I was part of a gold accord, as Joachim will remember. Gold is still part of the reserves. It's become less important, admittedly, than it used to be. But nonetheless, it has been underwritten by central banks and governments over a very long period. And that's a major difference. So there are some similarities in a sense that you could draw, but I think the one big difference that makes gold still a very different asset class is this notion that behind it, you still have a sense that governments have a use for it, however limited it may be in today's world. Very different even when I started at the central bank, but they're still there.
And a final cheeky question to each of you. So I'll start with you, Philip. Out of great admiration for your contribution today, I have decided to pay you a fee of $10,000, which you can keep or give to charity. I have not, by the way, just in case anybody else thinks I'm about to break out my checkbook. But for the purposes of this question, so you're going to get 10K in USD. Do you want it in USD, in Bitcoin, or in dollars? Or in gold? In gold. Dollars, Bitcoin, or gold?
I will take it in dollars.
Joachim?
No, Richard, I'm a decent central banker, so I will take a painting, Richard. Maybe the painting, you want to have my painting, then I get in a swap that painting that I see in the back of you. So.
Oh, that's a piece of cardboard. That's just
Forget it.
That's almost an NFT because it's a piece of cardboard that's printed. But I'll sell you the digital version of it.
Okay, I sent you the digital version of my painting.
Avinash.
I would take half in gold and half in dollars.
But none of you have taken it in Bitcoin. All right, gentlemen.
Much like last time, all the speakers did an excellent job, and it really was an incredible opening session. If you do have any questions, send them through to us at ask@lbma.org.uk. We'd love to answer them. If you do want some high-level summaries of this, you can go across and watch the conference wrap-up webinar. It should be linked at the bottom of the screen if you're on the LBMA website. If not, head to the LBMA website. Moving on to other events. We have distributed the invitations to our annual dinner. This year we're teaming up with LPPM and IPMI to deliver an event at the Natural History Museum, which is quite beautiful. The deadline to register for that event is fast approaching. It's on Wednesday, the 10th of November. Invitations were distributed to the primary contacts of each organisation who is a member of LBMA. So if you're unsure about whether or not you're going, not going, do get in touch with your primary contact. If you don't know who that is, just shoot us a message and an email to ask@lbma.org.uk and we'll let you know. We have some webinars coming up. 2 weeks from today, we have a webinar on responsible sourcing. 2 weeks after that, we have a webinar on investment and trade. So that will be moderated by John Reed from the World Gold Council. And it will also feature Tai Wong, who used to work for the BMO. Currently, he is an independent. We'll also we have more speakers to follow. So if you do want to attend that, please do register. The links are on our website. If you can't find it, just shoot us an email and we'll give you the details you need to be able to do that. We also have 2 training days, Introduction to Loco London and How to Use Loco London. So our spaces are filling up quite quickly and it's only in a couple of weeks. So if you are interested, you want to know more about the market, either on an introductory level, Introduction to Loco London. You already know a fair bit about it. How to Use Local London really is a more fine-tuned approach to the aspects which are delivered on the first course. So again, if you have any questions, shoot us a message and we will give you the information you need. And again, we've got a few months left on the launch sale rate for our next year's conference. The prices will raise after the 31st of December, and I know a lot of people will be taking Christmas vacation time at the end of the year. So make sure you flag this and register for your tickets to secure your place. That's it from me today. So enjoy the rest of your afternoon and your weekend ahead, and we will see you at the next webinar live in 2 weeks. Thank you.